Welcome to The Edge, where we explore the ideas shaping markets, money management, and policy. Today, we're diving into one of the most talked about fiscal changes in Nigeria, the recently introduced capital gain tax reform. Supporters see it as a move towards fairness, fiscal discipline, while critics warn it could dampen investments and slow market activity. So what does this really mean for investors, entrepreneurs, and policymakers? Joining me today to unpack all of this is my very good friend, Oladipo Ajayi, policy analyst, investment expert in the Nigerian capital markets, and vice president at Chapel Hill Denham. Together, we'll break down the policy, its design, and its potential impact on the Nigeria's economic future. Dipo, welcome to The Edge.
Thank you very much for having me in this today, Dr. Tony Okafor.
Right, my pleasure. So let's look at the big picture. First, I would like you to start by explaining to us what is this capital gain tax and why is it a major discussion point now in Nigeria?
Well, capital gain tax is basically the tax you actually pay on the gain you actually enjoyed on an investment. And one of the reasons why it's becoming more like the talk of the town currently is because of the new tax regime. Before now, capital gain tax in Nigeria used to be 10%. But one thing that I've come to understand is that we don't even actually implement or enforce the payment of this 10% capital gain tax. But considering that the current government is trying to actually realign the tax system in Nigeria, before now we have arrays of taxes being paid by Nigerians. So what the current government is trying to do is to streamline this tax system into just like about 8 different taxes. And one of these taxes is the capital gain tax. And but the reason why a lot of people are currently are talking about this this particular tax is because of the level of increase that taxpayer would need to actually pay if you actually fall within this bracket. Like I mentioned before, now it used to be 10%, but currently now your capital gain tax will not be taxed based on your PIT if you are an individual. So it means that it will actually flow to your personal income tax. So it simply means that if your personal income tax is effective 25%, it simply means your capital gain tax will effectively be 25%. And on the part of the corporate will have to pay based on CIT. And currently, the CIT tax rate in Nigeria is 30%. So it simply means that if you fall within that bracket as an organization, then it means that you have to pay a capital gain of about 30%. But the good part of it is the fact that the government tried to a great extent to actually protect the low-income earners. So it simply means that before you can actually qualified to pay the tax, it means like cumulatively you must have transacted up to like 150 million in the capital market, and that is at this point that you actually fall within the bracket of those who are actually liable to pay this tax. Of course, the main reason why the government is trying to do this.
Yes, let me quickly button before we go into the mechanics of how this is really going to work. What's the main motivation for hiking the capital gain tax? Is it for revenue, primarily for revenue generation, or a deeper policy goal that the government seeks to achieve? What's the main objective?
Well, Doctor, I think for me, I think it's basically for revenue generation. And when you look at tax to GDP globally, Nigeria tax to GDP is about the smallest globally. You've seen other emerging markets where they are close to about 20%. Nigeria is currently maybe about 11 to 12%. And before now, we used to even be within the single digits bracket. So the main motive is to actually improve the revenue generating capacity of the government. And I also think that the government actually also felt that the foreign portfolio investors are actually coming to Nigeria and make huge funds and leave without any form of tax paid to the system. I guess that's another way to actually get the foreign portfolio investors also to be taxed, considering the fact that they're also enjoying the valuation in Nigerian market.
But yeah, you mentioned that as it's about the capital gain tax in Nigeria is about 11% or 10% prior to these changes. How does this compare to peers in the region like Kenya, South Africa, Ghana, maybe Egypt, and all these other top African countries? How does this new move? How does it compare with other similar countries on the continent?
For me, I think the Nigerian government is too bullish in terms of with this level of increase. And for me, I also feel that we should have even started with the full implementation of the 10% that we used to have. Because like I mentioned earlier on, we don't actually have full implementation of the 10%. I can't imagine or I can't remember anyone paying capital gain tax on return on investment in Nigeria. Of course, there's a form of withholding tax that we pay, but nothing like capital gain tax when you actually invest in the capital market. And so I feel that we should have even wait around implementing or enforcing the 10% that we used to have. But when you now compare us with some other peers like Egypt, Egypt is currently about 20%. And like we all know, the basic for doing that is also what I mentioned earlier on, to also get to actually tax foreign investors. And I don't know whether you remember that at a point in time, Egypt was more like the destination for most foreign portfolio investors about 2, 3, or 4 years ago. So they understood that a lot of value, a lot of them are coming to their market to actually enjoy value. So, and that's one of the reasons why they actually left that rate around 20%. I also think that Nigeria is just trying to emulate what Egypt did, but I feel that we're too bullish in our increase. So I feel that within a 10% to a 15% would have been a very good place to start, just to actually warm the people into that tax regime. So I feel for me that is too high.
Okay, thank you so much. So let's look at the everyday investor now, both local and foreign investors. How does taxing capital gains at about 25% now or 30% for corporates, as you mentioned, how does it change the game for stock trading and even property flips? Because you see a lot of real estate transactions going on. How would this change the game? And are there any kind of exemptions or relief that I think you already touched on that earlier, where you mentioned that you need to make about, or you need to have transacted about 150 million before this actually kicks in. But I would like to know what your take is. How would this change the game for stock market investing and flipping of properties, especially in the real estate market?
I think currently we're already feeling the effects already because a lot of foreign guys are already reaching out to us to get full understanding of the impact on them. Because most times, when you're going to any economy now, you now need to look at what will be your net return rather than your gross return. So it simply means that before now, if you come to like Nigerian economy and you enjoy like a 20% return, but now with the enforcement or the implementation of the 30% CGT, so it simply means that your net return will be about 14%. So now you need to now compare what would that be net return in other clients in Africa. And I think that there's every tendency that you may likely see a better environment where you can get a better return than that 14% that you would have gotten in Nigeria net of the CGT. So the impact is that it will actually deter a lot of investment into Nigerian space, basically, into the capital market. And also on the part of Nigerians, Nigerians are not so much in tune with paying tax. So I feel that this may also be a deterrent. And don't also forget that this is a country that you are just trying to warn people back into the capital market after the crisis of 2008. A lot of people still have that in their memory, and most of them I don't even want to hear anything that have to do with the stock market. But based on the level of performance that we have seen in the last 2-3 years in the Nigerian market, that is already warming a lot of people back to the market. But when you now have to ask or not pay that level of tax, I think it could be a deterrent to a lot of people to actually come to the market. People would rather look for other form of investment that they can actually, or other places where they can actually invest without having the eyes of the government to actually pay tax.
So are you suggesting that this will push investors like towards holding assets longer, or drive more activity into informal channels?
So I think that we may likely see a lot of informed investors moving to more like fixed income space and basically government instrument, because this form of instrument, they are tax exempt. And because of the fact that they are tax exempt, so it simply means that a lot of people may likely want to just lock into this passive form of investment rather than trying to actually game the equity market. And also, like you mentioned, I think the savvy investors also can also continue to do the investment window. Of course, so it simply means that after selling down some of my position, I can just invest it back into another form of security. With that, I've been able to actually push the evil days forward. But don't forget that no matter how much you push the evil day, the day will come when you need funds, and when you actually crystallize some of these positions, and then you will likely have to pay. And I think it will also have impact on people in that regard. But I think that most investors that are actually savvy may likely want to move into the fixed income space where they can actually avoid the tax payments.
Okay, so we've seen the currency stabilize or even appreciate against the greenback recently. So observers have been worried, and people are saying, could this new move, could it deter foreign direct investments or even foreign portfolio investments? Because you could also credit some of the stabilization in the currency to the activities of these players. So what's your take on the balance between revenue generation and maintaining Nigeria's appeal as an African investment hub?
Well, one thing about foreign portfolio investors is that they are market stabilizer. So they come into the market to stabilize your economy, but don't forget that they also hot money. So when there's any little panic, they are the first to actually leave. But one thing we've come to understand that FDIs also look at what is happening with the FPIs before actually coming to the economy. Because now that we are enjoying this level of stability because of the fact that we are able to actually attract most of the foreign portfolio investors into our market, that's airport to actually stabilize the market. And after March, you can now start seeing foreign direct investment actually coming into market. So it means that they are more like the way maker into any economy. And they are not totally a bad form of stabilizing the economy, but just that you can't rely on them totally. We've seen what has happened in Nigeria. We know what happened during the 2015 saga when Nigeria was actually yanked off the JP Morgan bond index. As a Nigerian, we lost over $12 billion as a result of outflow of funds by foreign portfolio investors, and that also put a lot of pressure on the Naira. And that the Naira that we are currently seeing at 1,500 level now, it wasn't because what happened in the last 3 years was the reason why this currency is actually trading at this level. It was more like a bottled up effect that finally exploded. And now we found ourselves where we're currently. So for me, I don't think it's a bad deal for you to actually get them to help you stabilize the economy. But one thing is that you can't rely on them totally as a form of cash flow or as a form of actually creating aggression to your reserve. And the one thing that we have seen improved also in Nigeria currently is because, aside the fact that we've seen influx of foreign portfolio investment into the country, and don't also forget that we have also seen great improvement in oil production in Nigeria. At a point in time, we were just producing about 900,000 barrels per day. And don't forget that this 900,000 barrel is more like a JV. So it means that the IOC need to actually get their portion. So let's assume a 50% JV. So it simply means that Nigeria, what actually comes to Nigerian government is just about 450,000 barrels. And this 450,000 barrels, we also need to actually import refined fuel, gas, PMS, diesel, and the likes into the country. So at the end of the day, we ended up not having any form of cash flow into the system.
There is an increased revenue for the country now because we now have more crude oil production.
Yes, there are improved effects of revenue, and also on the expense side, we have been able to actually, with the emergence of Dangote refinery as well, instead of us to now actually import aggressively, we now have local supplier that can actually supply to the market.
Okay, great. So let's talk about the economic and sectorial implications of this reform. Are there sectors that you think will feel the pinch more? For instance, real estate, the stock market. Are there sectors in the economy that you think will feel the pinch most?
I think the capital market will have its fair share of the pain, and that's one of the things I mentioned earlier on, that the tax will actually deter a lot of people actually to invest in the market. And because firstly, people may not see the incentive to actually want to actually invest in the market in such a time like this. And also the real estate market as well. So it simply means that we may likely see increase in the prices of real estate assets because if I'm selling an asset and I know that maybe I used to sell it 200 million before and my return maybe is about 30 million. But now that I know that out of the 30 million, I'm going to pay 30% or 25% tax to the government, I may likely gross it up on the sale price.
On the sales price.
Just to actually maintain my normal return. So at the end of the day, you want to actually pass the final cost back to the consumer or the buyer of the asset, and this will actually push the prices or valuation of real estate asset upward. And for me, I think this may not be too good, most especially for the middle class that are still struggling to actually put roof over their head. So I think that these have impact also on other aspects, but I feel that the capital market will actually feel it more because it's more direct to the capital market.
Yeah, I see that this could be one of those unintended consequences, which we're not really sure if the government have taken this into consideration before coming up with those reforms. But let me ask you this question because I know you are pressed for time, and so let me ask. So implementation of taxes in Nigeria and enforcement has historically been uneven, which means we have the collection rates have been very low. So you have people who pay tax and then people who don't pay tax. So what do you imagine will be the biggest challenges in implementing a fair and efficient capital gain tax, like data tracking, compliance, valuation, or even perhaps taxpayer education? So what do you think would be the biggest challenges that the government would encounter as they seek to implement?
I think for me, the biggest challenge will be in form of data collection. Because currently we have our data just scattered all around. we don't have more like a consolidated data, and you'll see Nigeria has the BVN, and Nigeria has the NIN, Nigeria has the Nigerian passport, and Nigeria has some other national identity and some other ones like that. So we've not been able to aggregate this data together to actually form one particular data bank, because the concern has been that, like I mentioned earlier on, the current tax regime is not to actually burden the existing taxpayer. The focus is to actually further expand the tax bracket and expand the tax net.
Expand collection.
Tax net. Because if you look at it from this perspective, the CIT is currently at 30%, but the government is saying in the next 1 year it will be reduced to 27.5%. And another 1 year, it will be reduced to 25%. So it tells you that the focus is not about further belaboring the existing payer. The focus is to actually find a way to widen the tax to bring most of those people that have not been paying tax into their net. And my concern is that do you actually have the data of these people that are not paying tax? Do you know what they do? Do you know the form of revenue they generate? And how can you track some of these things? And that's been one of the concerns. And I remember one of the tax advocates in Nigeria, that is Taiwo Yedele, mentioned something around that the government is already working on digitalizing the tax collection system in a way that just like what they mentioned on your CSCS account, which means which has to do with your stock trading. It means that there will be your tax identity will be tagged to that account. So it means that we just put in your tax identity in the system. They can see your activity or what you have done in the capital market. And that to a great extent can actually give an idea of the level of return you have enjoyed and the likely level of tax you need to pay. And before now, unlike other clients like the United States, what Nigerians just do is that you just pay tax. There's nothing like tax filing. Of course, there's something called tax filing, but most Nigerians don't even understand what it takes to actually file their tax annually.
Yeah, so there will be a lot of policy or tax payer education that will be required.
Exactly. So now there needs to be a lot of education to people on the reasons why it goes beyond you just paying or your tax being deducted. Is at the end of the year, have you filed your tax return with the tax authority so that you can be clear for the year? And also, and I think one thing that would not be necessary that the government can now make more like a document that gives you access to is your tax clearance. So it means that every year you need to file a tax return and get a tax clearance. So your tax clearance will be what you can now be used for most of the things that you need to enjoy. And so I currently don't know how they want to actually fine-tune all this, but I know they're already working on modality, and we're expecting that for them to actually communicate that to us before the beginning of this year.
And we expect all this to kick in by January 1st of 2026. So in closing, let's look at the policy alternatives and the way forward. If you were advising the government today, what tweaks or complementary policies would you suggest to make the reform work without discouraging investments or overburdening taxpayers who obviously are reeling with the economic hardship in the last couple of years?
I think my first suggestion to the government would have been to actually revert the CGT back to 10%. Because, like I mentioned, over time, we'll not even be implementing or enforcing the payment of this 10%. So for me, I would have expected the government to do more like a pilot year where you actually enforce the payment of 10% and you look at what has come into the coffer of the government within that 1 year from that 10%. And that, to a great extent, could not give you the real clarity on whether to go ahead with the further increase or to maintain that 10% as a form of CGT collection. So I think on that angle, I will actually need to actually speak to the government in that area. And also another thing also that I will have also get the government to actually speak to government around is on the fact that the implementation of this, if there's any way we can actually implement this, it has to be without human interference, because for us to actually maximize this, we need to actually reduce the level of human interference with the collection of tax. If you look at the antecedent, there's been a lot of leakage. And that's one of the reasons why government is clamoring for to bring a lot of people into the tax net. Because even those that are currently in the net, a lot of people pay tax but don't actually see the effect of some of the taxes they are paid. So beyond actually implementing or enforcing tax, what is the value added that people are enjoying as a result of paying tax? Because if I can see the effect of my tax payment, of course, it will likely not be a burden for me to actually pay taxes. If you can notice that, oh, after paying my tax, there's security. After paying my tax, I'm actually driving on a good road. After paying my tax, there's good water. After paying my tax, I'm enjoying a lot of other things that people in advanced time are actually enjoying as a result of tax
the
payment.
taxes you pay actually work for you. I think it's been,
I feel that government needs to work on that.
Okay. Thank you so much. It's been wonderful speaking with you. Obviously, there are a lot of things that we need to discuss about these policy reforms, and hopefully we'll be able to get you back to further elaborate and provide insights into them. Thank you so much for joining us today on The Edge, and it's been a pleasure. Thank you.
Thank you very much for having me. It's a pleasure to be on your program today.